Well, good afternoon, morning, or evening to everyone, and wherever you are. And thank you very much for joining us. And in particular, I'd like to thank Keith for really hosting this event and the speakers who've joined us. These type of events are only as good as the speakers you can assemble, and we have a fantastic cast and slate of experts today. In fact, I think this is probably the first time this has ever happened where we've managed to put together the world's best performing pension funds represented by their most distinguished officials. So, hopefully there's a lot to be gained and a lot to be learned. Just a few words on the genesis of S8 nations. I wrote a book called Too Small to Fail, which talked about the success of small outperforming countries such as Singapore, Denmark, Netherlands, Israel, Switzerland, etc. There's been a lot of negativity and doomsdayers out there about how the world's evolving. But I mean, what you do find is actually in these small outperforming countries, there's a lot of very interesting pockets of progress. And of course, pension funds stands out as yet another example. Keith and David will be talking about the Mercer rankings, which came out, but the top 8 ranked pension funds in the world all have populations which are less than 25 million people. And of course, Steve Pinker says that there's so many ways for things to go wrong than to go right, but really what's important is success, because it's far more valuable to be able to explain what works than what fails. And that's, if you look at history, that's what it's all about. It's finding things, whether it's the wheel, the iPhone, or indeed, the best performing pension funds, and then figuring out whether you can reverse engineer aspects of that. And that's pretty much kind of in the essence of what S8 is doing, is trying to extract these fantastic oases of progress out there, where these small countries have already arrived at the future first, and then to sort of figure out whether there are lessons to be derived. So that's pretty much what we're doing. I think in the case of pension funds, it's a fantastically important and relevant opportunity. We were confronted with these aging societies. It was mathematically possible to be 100 years old just less than a generation ago. Now it's a distinct probability. We have a shrinking ratio of active to retired workers. We have capital markets which don't yield or cost anything, making it very difficult to generate reliable annuities during a time of your life when you're most vulnerable, because you can no longer earn wages. And we still wish to try to shape the debate around sustainability. So I think what I'll do, Keith, I'll just turn it over to you here, and then I'll come back at the very end and try to wrap up with some observations.
Okay, James, thanks very much. 2 things before we start. One is that if this next 2 hours was a train ride, I would be the conductor. So it's a 2-hour trip. There's 6 stops along the way. And probably my most important role is to try and get everything in reasonably on time. The second thing is that I think of this event as an exercise in integrative thinking. We all tend towards being specialists, silo-oriented. We're deep into our own thing. And every once in a while, it's important to step back and look at the bigger picture. And I think this is a good example of that. My hero in thinking this way is Peter Drucker. He wrote 1 book on pensions way back in 1976. And out of that came a number of books I've written. James put up his book. I'll put up mine. It's The Future of Pension Management. And it's very much Drucker philosophy driven. And what you'll see throughout is that we're going to be talking about pension design issues, organizational structure, governance type issues, and investing issues, and how those 3 elements ideally fit together. The logical place to start this discussion is with the Mercer CFA Institute Global Pension Index, because it is a way of integrating various elements of system and scoring them to see how well countries are doing with their pension systems. Anecdotally, I happened to be in Melbourne in 2009 when the index was launched by David Knox. David is the originator and still very much involved with this index. 12 years later, it's very much now in the public domain. It's launched every year, and the findings are written about around the world. And not surprisingly, maybe the 8 small nations are top performance in the Global Pension Index. So let's turn it over to David Knox to tell the story of the index and its key findings. So Jacob, if you can make that happen.
And thank you very much for the opportunity to talk today about the Mercer CFA Institute Global Pension Index. Pension systems around the world are under pressure from aging populations, the different economic environments, and of course, more recently, COVID-19. But what we want to do here is to understand the better systems and what we can learn from each other. The Mercer CFA Institute Global Pension Index looks at 39 retirement income systems around the world. We're in the 12th year of this report, and it has grown from 11 systems in 2009 to 39 systems in 2020. So how do we do this? We use objective data from international agencies, the OECD, the World Bank, United Nations, etc. And we supplement this international data with data from our Mercer colleagues in each country. Now, why do we do this? We do this so we can delve into each system in more detail, understand the rules, the regulations, and what's going on in the system, as well as the broader macroeconomic perspectives. It's important to recognize that the index is not absolute. It is comparative. What we're trying to do is identify the better systems and learn from those systems. To do this, we look at more than 50 indicators or questions covering a range of topics. Some of those questions are weighted more heavily, such as replacement rates and benefits, and others delve into the micro details of regulations and governance. It's important also to recognise that we look at the overall system. We don't look at what is the best pension system in the country or in the region. We look at what the system does. And that is because we are interested in what most people from a range of incomes will get from the system. Now let's look at the index in a little bit more detail. Within the index, we have 3 sub-indices: adequacy, sustainability, and integrity. What adequacy is all about is the benefits that you get or receive in retirement. In other words, what does the system provide? That includes the state pension, any social security, occupational pensions, and importantly, things that happen beyond the actual pension system, such as household savings or indeed household debt that would need to be repaid. As well as adequacy, we look at sustainability, because the pension system is there for many years, indeed decades to come. Can it keep delivering? There is a natural tension between adequacy and sustainability. A system can provide really good benefits, but it's not sustainable for the next 10 or 20 years. And perhaps Greece from a few years ago is a good example of one and not the other. The better systems both provide adequate benefits and are sustainable. But they also have the trust of the community. We need the confidence in society that this system will not only keep delivering, but keep delivering in a manner that meets the needs of retirees. Can it be trusted? So we look at regulation, governance, and the costs of the system. So now let's look at the results from the 2020 index. And what I've put up here is the results for the S8 nations. And wow, they fill in 6 of the top 7 positions, ranging from Netherlands in 1st place, Singapore in 7th. The only position they don't hold is 4th place, which is held by Australia. Switzerland and Ireland, also B grade, but a little bit below the top 7. But it's astounding that the S8 nations do so well out of 39 retirement income systems. Let's now delve into that in a little bit more detail. I said we have 3 sub-indices, and you look at the Netherlands, they are in the top 3 for each sub-index. Now, inevitably, across the S8 nations, there's a bit of variety. Some of the nations do better in adequacy, Netherlands and Denmark, sustainability, Netherlands, Denmark, but also Israel and Sweden. And when it comes to integrity, we see Finland and the Netherlands doing well. But every S8 nation, when you look at it on a global perspective, is doing very well. With a couple of minor exceptions, they're all in the top half for each sub-index. And that's an outstanding result for these nations. But what's caused that? Why do these nations do so well in respect of their pension system? Let's have a look at some possible reasons. Well, when you look at the population, these nations are down near the bottom. The Netherlands, 27th in terms of population out of 39. Sweden, 29th. Ireland, 38th out of 39. These nations on the global scene have small populations. Now, one of the possibilities could be that they have strong economies. So when you look at the GDP per capita, Singapore, Switzerland, and Ireland, the top 3. So that's maybe part of the explanation, but it's not the whole explanation. The GDP per capita, the economy is part of it, but when you look at the index results, it doesn't explain the full story. And I'm sure in today's seminar, you'll explore some of the reasons in more detail. But let's now come and think about why the Netherlands and Denmark have come out on top. What criteria do they have? Well, the first factor is that they have a base pension to build on. So there is a pension there that everybody receives. So you can build on that, and that gives a very good foundation. Secondly, their pension coverage is across the whole working population, or virtually all of it. Some other countries around the world might only cover half the working population. These countries have very good coverage of their occupational and personal pensions. Another good reason for their good score is that they are putting money into funded pension arrangements. You look at the top 3, Netherlands, Denmark, and Israel, all contributing at least 12% into their funded pension schemes. And of course, that means the pension assets are building up for the future. It makes the whole system more sustainable. Of course, when you have a base pension and you're putting money aside for the future, the net replacement rates are strong. So individuals in these countries can look forward to a good retirement with confidence. And building on that, the occupational pension systems have good design features. Money doesn't leak out of the system during the working years as it might do in some other countries. And finally, there is strong regulation and governance. Pension systems need the confidence of the community, and to do that, you need good regulation and strong, trusted governance. So it's fascinating that the S8 nations do so well, and I look forward to hearing how the seminar proceeds today. I'm really sorry I can't be with you in lifetime, but I do want to thank the S8 nations for bringing together the seminar today.
So that was the first stop on our journey. We're going to go now from 39 countries to 2. And there's Torben, and there's Zhangguan. The 2 specific countries that we're going to do a deeper dive into are Denmark and Singapore, both very high scores on the Global Pension Index. As you can see there, the 2 contributors to this session are Torben and Swan-Guan. Torben is the CEO of one of Denmark's leading pension organizations, Pension Danmark. And Swan-Guan was the CEO of Singapore's leading pension organization, the Government Investment Corporation, or GIC for short. He was CEO from 2007 to 2016. So, gentlemen, same question to both of you, roughly 10 minutes each. How did your country get to be near the top of the global pension index? How did it get there? And what can other countries learn from the Denmark and Singapore experiences? I have to note here, Torben, that you got a little help from David in terms of explaining some of the key elements of the Danish system, but I'm sure you can add to that. Torben, over to you.
Thank you, and thank you, James, for organizing this seminar, and also thank you, Keith, for being the moderator of today's webinar. Thank you for this opportunity to talk about one of my favorite subjects, the preeminence of the Danish pension system. First, a short introduction to Pension Denmark. We are one of the largest Danish so-called labor market pension funds, with approximately 750,000 blue-collar workers as our members, employed in 25,000 different public and private companies. We manage approximately 40 billion euro of savings, which corresponds to approximately a little more than 10% of the annual GDP of Denmark. Through reforms since the late 80s, Denmark has cleverly and also by some measure of luck implemented a system which makes for pension income adequacy, fiscal sustainability, and overall integrity, the three parameters in the Mercer index. Actually, every year since our start, the index has acknowledged the success and the good design, with a place among the highest ranking systems in the world, which we are of course very proud of, and we are very happy to share our experiences with other nations. The Danish pension system comprises the well-known three pillar as a tax-financed public pension for all citizens, so in the bottom of the structure, savings-based labor market defined contribution pension plans on top of that, covering more than 95% of the workforce, and then as the third part of the pillar, supplementary private or individual pension savings. This structure ensures the sharing of risk across generations through the pay-as-you-go, the basic public pension part of the system, and among generations through labor market pension benefits being annuities based on a life insurance principle. Labor market pension savings were introduced for blue-collar workers in the early 90s. These are still actually relatively young, but they will mature around the middle of this century. And after 2030, benefits from the savings-based part of the pension system will provide somewhere between 50 and 75% of pensioners' income, where going, let's say, 25 years back, more than 90% of the income of pensioners came from the public pay-as-you-go system. So a really radical transformation of the income structure for the old age population. The new labor market pensions schemes were a result of three-party negotiations between the government and the labor market social partners, unions and employers organizations. And from the onset, the system was designed to substantially increase private savings, which also along the way has helped turn the Danish annual balance of payment deficits into huge surpluses. So the private saving level has been substantially increased through the build-up of pension plans. In the early 90s, we started up very modestly with contribution levels at around 1% of the wage jump, but now during the next 15 years, the contribution rates were raised, and now blue-collar workers provide contributions between 12 and 15% of their gross monthly income into the pension funds. So the contributions are managed by a number of pension funds with some kind of competition on cost and returns, which makes the system, let's say, competitive and so public pensions guarantee a minimum income level, safeguarding against poverty. We have no poor pensioners in Denmark, and the labor market pension savings provide attractive net compensation rates on top of that, plus a large degree of flexibility in the precise design of the benefit program. So today, a typical pensioner retiree in Denmark has an income somewhere between 65 and 95% of her or his income before retirement, making it possible for pensioners to maintain an attractive and good level of living standards. But to address your second question, Keith, as everywhere around the world, the Danish pension system is challenged from two sides: rising longevity and low interest rates, low rates of return. Demographic changes and rising longevity implies a rapidly aging population, which put a strain on public finance and private pension funds alike. A cornerstone in the Danish structural labor market and pension reforms during the last decades is the introduction of an legal implemented indexation of the retirement age to increases in longevity. Every 5 years, the formal retirement age is reviewed, and if life expectancy has risen, you will raise the retirement age. So a few years ago, it was 65. Now, in a few years' time, it will be 68, and in 10 years' time, it will be 70. And we expect that the retirement age 20 years from now will be somewhere between 71 and 75 years. So a large part of the increase in longevity is financed by expanding the period of your life where you are still a part of the working force. The other challenge comes from the low interest rates. Although we have had a decade with attractive returns on stock markets, looking forward, our main scenario is characterized by relatively low returns, also low real returns. This has encouraged us and other institutional investors all over the world to increase our allocation into alternative asset classes outside the listed areas, like real estate and infrastructure, things like that, where you get access to higher expected rates of risk-adjusted return, and where you get, let's say, get paid for the fact that you, as a long-term pension fund, can accept a high degree of illiquidity in your asset base. We have now direct investments in real estate now account for a little more than 10% of our total portfolio, and our direct investment into infrastructure assets, in most of them in renewable energy, stuff like off and onshore wind farms, is another 10% of our total balance. And other non-listed assets account for other 10%, so 30% of our assets now are outside listed markets. And just to make this a little add-on remark, there's no doubt that the investment policy of institutional investors will be a crucial part of the financing of the green transition and to deal with the climate challenge in the coming decades. And we think that we have found an interesting way to allocate a substantial part of our investments into, let's say, the green transition, where we at the same time get attractive returns, but also give our contribution to the necessary transition to a 1.5 degree scenario. The Danish government has set a very ambitious goal. In 2030, the CO2 emissions from Denmark have to be reduced to 70% of the level in 1990. And to do that, we have to mobilize private capital at a large scale. The Danish pension fund industry has made a, let's say, common pledge to invest extra 50 billion euro in the green transition over the next decade, by that providing the majority of the funding of a number of green transition initiatives in Denmark, but also with the outreach to the rest of the world. My last remark goes with the issue of governance. Maybe you saw that Wilbur Mercer gives us only a medium position when it comes to integrity. Actually, we have questioned this position. We think actually we have a quite advanced governance structure in the Danish pension system. In the 90s, there was a focus on the member democracy and competition. The financial crisis 10 years ago made a change. So now there were focus on governance and board competences. And lately, the need to shift to alternatives in your portfolios has necessitated a new focus on asset valuation and risk management for our FSA and other financial supervisors. So to sum up, there's a need for constantly rethinking the question of the optimal governance of the pension institutions who manage mandatory savings plans. So also in the coming years, we certainly will see changes in both the investment programs and in the overall management structure. One of the most striking features with our pension fund is the fact that we, during the last decade, has supplemented our, let's say, asset management, taking care of members' savings with a very large preventive-focused healthcare program, which all members now are enrolled in, and a program where we are co-financing lifelong learning for our members. So we have now a holistic approach to taking care of our members during their working life. We take care of their savings, of course, but we also assist them in keeping up a good health and keeping their competences at a high level, so they will continue to be an attractive part of labor market up till retirement, which also will increase their savings and by that increase their living standard as a retiree. Thank you very much, and look forward to answer any questions later on in the program.
Torben, thank you very much. Just a 5-second summary. What I heard was 3 things: raise the retirement age, rethink your investment policy to deal with a very different return prospects, and strong governance of the pension organizations, including the whole communication side, being tremendously important. I think those are 3 great things for everybody to think about and to see what they can do with that. Xiang, go on, over to you now. The Singapore story.
Okay. Yeah, I know how. Right. Well, thanks very
Here
much,
we go.
Keith and James, for organizing this time, and hi everyone for listening in. Just a quick description of the Singapore pension scheme. The Singapore pension scheme is embedded in our Central Provident Fund scheme, which everyone in Singapore knows as the CPF, the Central Provident Fund. The CPF is Singapore's comprehensive social security savings plan. It is a mandatory, fully funded savings and pension plan for working Singaporeans and permanent residents. Contributions are tax-free, earnings on the savings are tax-free, and withdrawals are tax-free. CPF members use their savings with the CPF to purchase their homes, to pay for their medical needs, and to fund their retirement. The CPF began in 1955 when Singapore was still then a British colony. And when it started, it was purely for retirement savings. Employers and employees each contributed 5% of wages into individual CPF accounts. After independence in 1965, the use of CPF savings was gradually expanded to include payment towards housing mortgages, to meet healthcare expenditure, and to pay fees for tertiary education. And to do this, the total contribution has risen from the 10% in 1955 to 37% today. That's a very large sum, but it's accounted for by the fact that you got this multiplicity of users. Of the 37% contributions today, employers contribute 17%, while employees contribute 20%. The availability of CPF to fund housing mortgages has resulted in 90% of Singaporeans owning the homes they live in. So home ownership is, the government decided, was just a very big motivating factor to give stakes to Singapore, to citizens in the future and the wealth of Singapore, and hence the reason for expanding the CPF scheme to allow for payment towards housing mortgages. But the 37% of total CPF savings is split into 23% in what we call the ordinary account, which may be withdrawn to pay for housing mortgage installments or fees for tertiary education, then 6% in what we call the special account, which cannot be withdrawn until retirement, and 8% in what we call the MediSave account, which may be used for hospitalization and medical insurance. The percentage distribution varies slightly with the age of the CPF member, with more going towards retirement and healthcare as they grow older. CPF savings in the ordinary account earn interest at a minimum rate of 2.5% per annum, while savings in the special and MediSave accounts earn interest at a minimum rate of 4% per annum. An extra interest of 1 percentage point is paid for the first $45,000 of CPF savings, and members from low-income households are paid yet another 1 percentage point extra for the first $22,500 of their CPF savings. So in essence, therefore, although the minimum rate is 2.5%, the initial part actually earns 3.5%, and for people from low-income households, they earn 4.5%. And similarly, for what is finally used for retirement and for medical expenses, although the minimum rate is 4%, in fact, the people in low-income households get 6%. Members can choose to invest their CPF savings themselves in gold or the stock market or other investment instruments, rather than take the guaranteed interest payouts. That's really their choice, but very few people take that up these days. The CPF board, which are trustees of CPF schemes, do not invest the CPF savings themselves, and this is an important distinction from many other pension funds around the world. The Singapore government takes on the risk and the responsibility by issuing special government securities back to back with the CPF board's obligations to its members. So in other words, all the responsibility for investment returns is actually taken by the government, and in return the government takes and gives its guarantee for these interest rates. So total CPF savings today are about 340 billion US, with total members coming to 4 million, while active membership is half that at 2 million. Total withdrawn to meet housing mortgages needs each year is about 14 billion US, with withdrawals made by almost 1 million members. The CPF is based on individual accounts, but there is pooling for payment of lifetime annuity from the age of 65, based on what the member has in his retirement account at that point. And there's lifetime insurance for what we call catastrophic illnesses, things like prolonged or serious illnesses like cancer, which involve high medical costs. So there's lifetime insurance with premiums payable from the MediSave account. CPF members can withdraw their savings plus interest accruals when they reach the age of 55 years. And they can withdraw beyond the minimum sums they need to have for MediSave and for retirement. So basically what happens is that when a member reaches 55 years of age, he can take out a minimum of $5,000. And so long as he puts aside what the government determines to be minimum sums they need to have for MediSave to look after them for the rest of their lives on the medical side, and for retirement, again, for lifetime, for the rest of their lives, and that once this is put aside and kept within the CPF system, the member can withdraw everything else when they reach 55 years of age. I would say the particular feature of CPF that make it attractive as a long-term scheme, just quickly to summarize, is the comprehensive social security plan. It provides for housing, for retirement, for healthcare. It is individual accounts. It is fully funded. It is contributions, earnings, and withdrawals all are tax-free, and the earnings are guaranteed by government. Now, this is the important distinction I want to make. I know when Keith introduced me as the CEO of the GIC, but I want to explain the GIC is not the pension fund of Singapore. The pension fund really is what I described as the Central Provident Fund. The GIC is the Sovereign Wealth Fund of Singapore, and a good part of the CPF savings or contributions are in fact taken up by the government issuing their special securities, and then a good part of that is passed on by the government to the GIC to invest. The advantage the GIC has, it invests for long term. Whatever comes on CPF is now mixed with everything else that Singapore has in terms of its national financial reserves. And so you got a much bigger base upon which to do the investing and hopefully to get the better returns. We note about the sub-indices for the briefing that was given much earlier on the Global Pension Index about adequacy, sustainability, and integrity. And the report has specifically suggested that Singapore considers 3 changes, which they say will improve the overall score. One is to reduce the barriers to establishing tax-approved group corporate retirement plans. Second is to open CPF to non-residents. And third is to increase the age at which CPF members can access some of their savings before age 65. I just want to explain very quickly this, right? CPF members currently get, as I explained, a minimum of 2.5% interest, but the actual interest they get varies from 2.5 to 6%. The big problems, especially in today's low interest environment, is virtually impossible for anybody to consider anything like 4% or 5% or 6% to be given on a guaranteed basis to the members. So basically what happened is that there were group corporate retirement plans previously, but all of them switched their employees to the CPF scheme because in the end the CPF scheme guaranteed the return and the interest income. But more importantly, the CPF scheme allowed all the usage for housing and healthcare and so forth, which the group corporate provident fund schemes did not. Second, on opening CPF to non-residents, it used to be that it was open to all employees in Singapore, but this was stopped about 20 years ago. And the government instead introduced a plan called the Supplementary Retirement Scheme, which where people can make voluntary savings, tax relief on contribution, no tax for investment returns, and 50% tax on withdrawal. But basically what has happened is once the government had focused on just citizens and permanent residents, and the policies the government adopted and provisions that they made for CPF now becomes very clear in that they are for people who are going to be long-term in Singapore, and therefore you have to plan for their healthcare and their retirement on a long-term basis. Rather than previously, there was this mix of people who are here just for a short time as opposed to people who are here for a long time, and for many of them for the rest of their lives. And so far, CPF members getting access to some of their savings before 65, as I explained just now, they can actually get access from 55. No doubt, a lot of this the sustainability point is very dependent on a long-term perspective on part of the government, and very dependent on good overall management of government finances. So you really need to trust overall the government that they will deliver on the promised interest rates, which is written into law, the 2.5% written into law, and everything else builds on 2.5%. Well, I'll be happy to take whatever questions there may be at the end of this session. Yeah.
Thank you.
Yeah.
Well, the train's running on time this far. I can't help just to give you, maybe ask you one question each, just very short at the end, which is, two great systems, very integrative. How does it change over time? What are the dynamics for change? Where does politics sort of hit reality, and how does that happen? Just very briefly, Denmark and Singapore. Torben?
Well, there are, of course, many dynamics in running a pension system. Only the long-term character. I mean, the young members who have entered our pension plan this year will retire in 2070 and be pensioners to the end of this century. So, of course, there will be a lot of changes in this 70, 80 year long period of time. For us, taking a look backwards, I think the most important thing is the development of digitalization, which have made it possible for us to combine the economic efficiency of a large-scale pension fund with a high degree of individualization of services and products. Actually now, every member of our pension plan has a customized product where we take into account your family situation, your health situation, your preferences for retirement and so on, which was not possible 10 years ago without having a very high level of cost. Now we can combine low cost with an excellent individualized service, and I think we will continue this movement in the coming years. The second thing is the challenge to our system is the growth in, let's say, non-traditional types of work with people who are living as, let's say, individual entrepreneurs with no firm employer and are not covered by the mandatory pension contributions plans. We're never discussing whether we should make a legislation, make it mandatory for these new types of laborers to be enrolled in a traditional pension plan, but that has not yet been settled. So just a few.
Okay.
There are much more, but that to remark.
Okay, Keith.
So go on.
Yes,
How do you get change? How do you get change in Singapore? How does that happen?
Well, change happens when there is crisis or when people can imagine the crisis. So quite frankly, I mean, this is what it is, right? Housing, for example, people being able to own their homes traditionally, especially in Asia, I think people have this great sense that they want to own their homes. So we say, if you want to own the homes, this is what you do. Quite frankly, the history of this was that when Singapore first started, of course, our wages were low, productivity was low. As productivity improved, of course, you should be increasing the wages. But what happened there was this became a mandatory savings. So instead of raising the wages in a substantial way to increase the out-of-pocket, to increase what people get in their pockets, the government decided to channel that into the CPF and allow people to take those savings out to pay for their homes. So you have this combination of two different factors. One is people want to own their homes, so you create a scheme to own their homes. And second, we are really saying, I will channel it through the CPF so that those who don't want to use their money for homes, what they're doing is saving a lot more, a lot faster for their retirement. Otherwise, they can use it for their homes. Rather than if you just leave people their choices, they may not actually direct it there and they just spend on their day-to-day, whatever it is they want day-to-day. So I would say being able to see the crisis and really the expansion to healthcare was really about saying, as medical costs go up and as people can see their parents getting old, their parents getting more sickly, you inject that scheme in and people will buy it because they can see what the crisis is. But most critical thing, of course, is that the government itself needs to have this long-term view as to where they need to go. The timing and the context is very dependent on the opportunity that arises and how well you can communicate.
Yeah. Right. So what's interesting is that you're giving people choice, but within a context that's been well thought out, which is brilliant. Okay. We'll come back to you, gentlemen. Thank you very much.
Thank you.
And we'll move on to the next session, which is titled Building a Great Pension Organization, a story, and in brackets I've got beside that, there's Claude. I've got the sort of the anomaly here is that this is a story out of Canada, which doesn't qualify as a small nation because James has decided, I think, to put a limit of you have to have fewer than 20 million people to be a small nation. But thank you, James, for inviting Canada to be sort of an honorary member, at least for now, for the small nations group. So Claude is going. We're going to have a conversation. Claude Lamoureux is the founding CEO of Ontario Teachers Pension Plan. It's an organization that was originally came into being legally in 1990. And Claude was CEO the first 17 years, very formative in terms of how the organization evolved over time. Why speak about Ontario Teachers Pension Plan? Well, 30 years later, we do now a lot of benchmarking in terms of organizational effectiveness, in terms of creating value for money. And it's fair to say that over that 30-year period, Ontario Teachers has scored very well on a global basis in terms of creating value for money, both on the investment side of the organization and on the whole benefit administration side. So this is now a conversation, well, given this great performance, where did that come from? And, is it replicable? Can other organizations actually do it? Just let me do a little bit more of the buildup. I mentioned earlier on Peter Drucker as my hero in terms of how to do integrative thinking. It led to my first book in the mid-1980s, Pension Funds and the Bottom Line. And it was basically taking a business approach to creating and managing pension organizations. Ontario, the province of Ontario, in its wisdom, decided to have a study on the effectiveness of pensions in the province of Ontario in the mid to late 1980s. Out of that came, I happened to get involved with it to some degree. And what came out was a study and recommendations titled In Whose Interest? And that was sort of an interesting way to think about who you need to think about in order to create great organization. Part of the recommendations was to use Peter Drucker principles to create a business-like organization to be the pension organization. Surprisingly, the recommendations, usually these recommendations are shelved after the study is done and never thought of again. In this particular case, the treasurer of the province of Ontario, plus the president of the Ontario Teachers Federation, decided we should do this. And out of that agreement came Ontario Teachers. It took 2 years to go through all the whole process of creating the organization, putting a board together that was not only acting in the best interest of, but also had professional competence. The first chair of the board was the just retired governor of the Bank of Canada, Jerry Bowie. And the search started then for the CEO of this brand new organization, Drucker Principles. And that led to Claude, who had been a senior executive at MetLife, to agree for the interview. So Claude, why don't you talk a little bit about how your conversation with Jerry Bowie, chair of the board, and how do you discuss what the job would be that you would be stepping up for if you decided to take it? How did that conversation go?
All right, thank you. And it's nice to be here this morning. The conversation was easy. First, I had an interview with the whole board. And A day later, the headhunter told me, Claude, they want to offer you the job. And the organization used to be called the Ontario Superannuation Fund, and this sounded kind of old-fashioned. So I said, well, I'm not really interested in this job. He said, well, why don't you have a luncheon with Jerry Bowie, who's of the stature, if you want, of a Paul Volcker, in case people don't know Jerry Bowie, but somebody very tall, who had been a governor of the bank for something like 14 years. So I could not resist. I said, yes, I'll go and have lunch with him. And so we had a great conversation. And one of his key questions was, Claude, if you join us, how would you run this? And this goes back to what Keith just said. But I didn't know that was part of the thinking. I said, well, it'll be easy. I'll run it like a corporation. So his next question was, well, what does that mean? Well, that means that, the CEO runs the place, reports to the board. I'm totally transparent. I'm not somebody who hides stuff. We'll have corporate title. We'll have competitive compensation. We'll manage, I'm a big fan of management by objective. And so we had a good conversation. And at the end, he said, are you going to join us? I said, I'm going to join you. And I can tell you the real reason I decided. When I mention all of these things, including the compensation, Mr. Bowie never flinched. Yeah. And, when I came back home and told my wife I've just accepted a job that earlier I had told her I wasn't going to take, she said, well, why did you change your mind? I said, I can get along with that person. And sure enough, I think that Mr. Bowie and the board gave me a lot of freedom, and there was a lot of level of trust that I really like, and that I always had with all the chairmen, the teachers. But Jerry started the thing on the right track, so that's how it started.
So then, part of the story now is that you and Bob Bertram, who you hired as your chief investment officer, started to do some very unconventional things very quickly. You started to privatize publicly traded real estate companies. You created a swap program for your non-marketable debentures. You decided to insource a lot of your investment or your investment process over time. Where did these ideas come from, and what did your board think about them?
Well, during the interview with Mr. Bowie, one of the things that I said that, I used to run an insurance company. I said, probably we should manage 80% internally and 20% externally. And the main reason for that is that it's a question of cost. And I thought that we could attract really good people. And as you mentioned, the first person that was attracted was Bob Bertram. That was a key hire. And we had a partnership that lasted 17 years. And, Bob was an outstanding person, did a great job. But we inherited 16 billion of non-marketable, non-assignable, non-negotiable Ontario government bonds. So the board at the time thought that diversification will come from contribution minus benefit, essentially new money plus the maturity of these bonds. But Bob had a different idea. Bob said, why don't we do a swap? And he had done that in his prior job. And, so he explained that, we had a lot of discussion about the control that we needed and things like that. So, our first swap was $1 billion swap from Ontario government debenture return to S&P 500. Well, when we presented that to the board, everybody was like, wow, we didn't think of that. One, they wanted to make sure that it was legal. They wanted to make sure that the federal government knew what we were doing. We even told them that this had a very attractive feature. At the time, pension funds could only invest outside of Canada 20 to 30%. So we said, well, that way we could essentially get all our return from outside Canada. And again, people were a bit shocked by that. But we had an outstanding lawyer on the board, and he said, yeah, these things would be legal, blah, blah, blah. But, we did more research as a result of questions by the board. But that's how we got going. And they accepted the idea that we would run, most of the money in-house, and that we would build an organization that, would essentially manage most of the money, including private equity, including infrastructure. We were very early in derivative, and this became a huge advantage, because when it came time to invest in hedge fund and things like that, we already had people that understood what was involved, and we really made sure that we built a very strong accounting and control organization. I remember hiring an outside auditor and telling him, he was a retired partner from one of the firms. I said, but you have a reputation to lose. I mean, what I want you is to make sure that we have good controls, you have total access to the board, because at the end of the day, if you have a car that can drive fast, you really need strong brakes. And he did an outstanding job. But the whole idea was to build an organization, and Bob Bertram was certainly one of the persons that I relied on to run that part of the show, and he did a superb job for many, many years.
Claude, one final area, switching to the whole benefit balance sheet side. The tradition with defined benefit plans was that the benefits were guaranteed. End of conversation. And what happened with the passage of time, of course, that became a increasingly more difficult dimension of defined benefit plans. Why don't you talk a little bit of how you got the board and the partners to think about making the benefits more variable, dependent on how the funded status of the plan? How did you manage that?
Well, when you start a new organization, you need to build credibility. And I'm a great believer in, being very open, not hiding anything. And really, we had to convince the Ontario teachers government, the Ontario teacher and the government, that we knew what we were doing, that we could manage the money in-house, but also that we would have a very strong risk organization. And part of looking at the risk is, can we afford these pensions for a long, long time? And the other thing that the Ontario teachers were never happy before was the valuation. It was always, they always wanted a different, mainly an interest assumption that was more aggressive. But again, we had an outstanding actuary who was able to gain their confidence over a period of time. And to me, that was very important, to gain the confidence of the teachers and the government. Because if you cannot do that, then it's very tough to come up with new things. And when we did derivative, I can tell you, we spent a lot of time explaining to the teacher what the swap was, how it worked, what happened, because a lot of people were surprised that you could do these things and it looked like, you're just shuffling around paper. But no, these are legitimate transactions. So we worked very hard to gain their confidence. And if you go back in 1970, there were 10 active people for one retired. When we started, it was 4 for 1. And we had a fairly large deficit at the time that we were able to. But the more we studied the whole demography of the teachers, we knew that the population was going to age. And as a result, changes had to occur. Through you probably, and through, you probably introduced that to the Dutch, but we borrowed an idea from the Dutch. Essentially, how do we make sure that this plan lasts forever? And one of the things that I learned is that, well, the retirees can share in the risk. And this in North America, I had never seen that. So we borrowed that idea and we started talking about it, and we could demonstrate that, yes, today you have 4-for-1. Fast forward, this is going to become practically one active for one retired. And if you have a problem, like if you lose 10% of your asset, this is not sustainable, because at that point, you got to increase the contribution by a lot. So you got to find a way to make the plan a permanent one. And over time, we talked about it, and my successor, Jim Leach, was able to close the transactions and to convince the government. Well, the government it was easier to convince them, but to convince the union that retirees could share in their risk, it would be to the advantage of everybody, because the alternative is a defined contribution plan. And I like to say that the best defined contribution plan is probably not worth the worst or one of the worst defined benefit plan. So we convinced the teachers that this made sense. And today, the retirees share the risk. This, if you look at the annual report, there are trigger points. If the funding is lower than this, here's what happened. Then it's mainly the inflation benefit that they share in the risk. So the inflation protection gets reduced, contribution can increase for the active. And today, I think that both the government and the Ontario Teachers Federations have a lot of faith that this plan will last forever. And that's the important thing for the teachers of the province.
Claude, we could keep chatting for the next half hour, but I have to put on my train conductor hat.
Yeah.
Our time is up. I think this has been a great conversation, and we maybe have some more time at the end to come back and carry it on. So thank you very much.
You're welcome. Anytime.
Well, this is an interesting transition from a conversation with Claude to a conversation with Eloy. And Eloy, it was a nice transition from conversation with you now about the Netherlands context. Just by way of introduction, Eloy just retired as the Chief Investment Officer of the Netherlands' second largest pension organization, delivery organization, PGGM. And he was in that position for 9 years. So that's a lot of work in the trenches of investing retirement savings. So let me set up the conversation with you. And it gets back to something that's already been mentioned a few times, which is this new return environment that we live in. And what do we do with it in terms of being able to deliver adequate pensions at a reasonable cost? I mean, that is always the goal. And we seem to be in a different situation. So I wrote a piece on that last September, basically saying that the old 60-40 investment policy rule of thumb has been around for decades. 60% equity, 40% bonds. And when you do the calculation, if the 40% bonds has a negative real return, then you can no longer get an adequate pension at a reasonable cost. And you have to rethink that 40. And so what do you do? What do you think about? Well, interestingly, Torben already earlier mentioned this notion of various types of new investments, infrastructure, et cetera, et cetera. The thing that I added was the idea that, the stock market is too big a thing to really make sense out of, and that you really need to disaggregate it into components of the stock market, and that there is a component of the stock market. And I used Unilever as the poster child of a company that has a clear market, has good management, has a 3% dividend yield, has reasonable growth, and for long-term investors, like, how risky is that? That was sort of my proposition out there. So over to you now. When you think about future investing in a low return environment, what comes to mind? What have you been thinking about?
Okay. Well, first of all, Keith, let me thank you and the S8 organization for having me here today. And I think it's a wonderful initiative to bring together experts and share best practice so all can benefit. Now to your question on the 60-40 in this current environment. I think I agree with your thesis that in this very special environment where central banks are actually depressing risk-free rates, nominal risk-free rates to negative levels, and real rates to negative levels, clearly a large part of that traditional bond portfolio is not a good pension investment. So that's certainly true for Europe, and it's increasingly true for North America and places like Japan, I would think. It's less so the case for emerging markets, and I know we have a number of participants on today's program that are from emerging markets, so much less so there still, because you still have good real rates there, with central banks not engaging in massive buying operations, suppressing rates. So we do need to look for alternatives, and one of the things we've done, for instance, in the Netherlands, is that we did shift focus to those areas where the central banks have less direct influence on the pricing mechanisms and where you have more of a liquidity premium. So private markets, stable cash flows, basically long-term investments that are there to stay in your portfolio are getting an increasingly important role. I think Torben gave nice examples about how sustainable infrastructure, for instance, residential real estate, the advantage of those assets is that they actually have a link to inflation also. So there's a real return. So core real estate, core residential real estate, core sustainable infrastructure such as windmill farms or other forms of renewable energy, you can see clearly that they have a low but stable real return and the advantage of an indexation. And if we're thinking that, we need assets that match liabilities that have an inflation component to it. We want to keep people out of the poverty trap. So we want to have some kind of link with inflation. So these investments are much less risky in the current environment than actually a traditional government bond. And I think that's precisely where we get to the point of regulation, that regulators have lagged behind in not recognizing that the so-called risk-free government bond for the pension funds in places like Europe, for instance, and increasingly also in other places where low rates are becoming dominant, is not a risk-free asset. It's actually a risky asset, which can detract from a good pension outcome. So it's very important that when we discuss pension reform going forward, the challenges that regulators also give long-term investors the leeway to actually transform their portfolio to more private assets and to these safe, stable cash flows, and to see them as these core assets as something that can in fact replace what we would have called a government bond in the past. I must say the regulator in the Netherlands has become more willing to support that move, and pension reform also will allow these type of investments to be made.
So that was actually my follow-up question, which is, I know this has been a frustration with you, of course, because the traditional Dutch regulatory regime has been very solvency-oriented, mark-to-market oriented, and has defined this bond that you described as not risk-free as risk-free. And that's caused a lot of unhappiness, including pension cuts. And now the big transition. You want to just, ironically, this is in the Global Pension Index, the #1 country in terms of ranking, has had this issue of having to change its regulatory regime. Do you want to comment on that?
Absolutely, yes, thank you. It's true that the regulations in the Netherlands have basically forced pension funds to invest a lot of their available capital into government bonds, and also to actually leverage their balance sheet with a lot of swaps to actually immunize their solvency ratio for falling rates. Now, actually, over the past few years, that has allowed pension funds to actually reap massive returns for those positions, obviously falling rates. So most pension funds have actually benefited from having leverage in their balance sheet with swaps and having these huge positions in long-term bond portfolios. So that nuance is important to know, that on an asset-only basis, actually returns on those positions have been good. However, going forward, we have a totally unsustainable position. So for instance, in the Netherlands, on average, if you count in the leverage in the balance sheet, about half of the assets are now linked to negative yielding or real negative yielding assets. So going forward, we're sitting on a time bomb. And in that respect, it's very important that we now move forward with pension fund reform, and social partners are well aware of this problem in the sense that there's a high sense of urgency to reform the system. And I think the big benefit so far in the Netherlands that we've managed to keep the pension reform from becoming politicized, which is crucial. So people complain that we've been talking about this for 10 years. But then again, we're talking about an amount of reserves which is well in excess of, it's nearing 2 times GDP. So you have to be very careful in the way we redesign this. And you need full buy-in of the social partners, the unions, the employers, the participants in the pension funds to have a high trust level in the system going forward. So we're moving to a system which is going to be easier to communicate with participants. It's going to be easier to communicate how you participate in the accumulation phase of the fund and in the decumulation phase of the fund, and what choices there are. So we're going to move to a system which is more transparent and has much more emphasis on communication. And thereby, we hope to support trust levels in the system. I want to also underline here that it's extremely important that we maintain mandatory participation in this system. We don't give too many options to people to choose different, styles within, the two-pot system. So limited choice, because that will increase complexity, and it will ultimately increase the cost of running the system. So mandatory participation is actually crucial to keep the long-term capital formation in place, which allows us to be a long-term participant in private markets, to internalize these investments. We're very much inspired over the years by the Canadian model. I was glad to hear that the Canadians were inspired by the fact that you can actually lower pension benefits as one of the safety valves in the system. But we've learned very much from the Canadians that we need to internalize our investment activities to keep costs low. So for instance, during my tenure at PGGM, we doubled the headcount of our investment management organization, internalizing infrastructure teams, other alternative asset teams such as private real estate, risk-sharing transactions with banks. And we also started providing mortgages to our participants. So PGM was the largest supplier of mortgages in the Netherlands, new supplier of mortgages the last 2 years, providing 3 billion in mortgages to our own members. And mortgages are a great replacement of government bonds because they give a yield pickup of, let's say, 160 basis points over government bonds. And we were able to provide our participants in the healthcare sector with a special mortgage facility where they could also bring in their variable rate hours, get a higher mortgage, get mortgages to make their house more energy efficient. And people are very happy that they see the value out of their pension fund. So going forward in the low yield environment, it's also crucial that the participants in the fund understand that your pension fund does not only contribute to a sustainable pension, but it also contributes to a better world. It's contributing to a better environment. It's contributing to other elements which people find important. And in that regard, it's also important that we have large professional organizations with the scale to actually do these type of things. So Yeah, I'm positive that we are able to kind of further develop our system and keep it stable going forward. But it requires fundamental changes to the way we invest and the way we communicate with our policyholders.
So one final question. I did a project with Professor Nicholas Barr, actually for the Finns about 10 years ago. And the key concept that he kept impressing everybody with, including me, was the power of path dependency. That you can't necessarily get to where you want to go. You have to look at where you've been to see whether you can get to where you want to go. And it just strikes me that the Dutch system is in that kind of a position right now, where you know where you've been, you know where you'd like to go, but can you get there? What do you think are some of the key elements that have to be put in place in order to make that transition from the past to the future?
Yeah, okay. So first of all, I think there's a number of challenges going forward. First of all, we have 2 elections between now and the actual implementation date of the new system. So my earlier point that we have to keep this process depoliticized is crucial. And so far, the stakeholders are very aware of this and very careful not to politicize it. And one of the things I actually think helps is the fact that we have, there's increased sense in society of the importance of collective action, solidarity, and trust with everything that has hit us with COVID. So that is also kind of leading to a reevaluation of collectiveness. And although we are moving to a more individual system, actually the Netherlands at this point is unique, I think, in the global context of its pension reform, that it is moving to CDC with individual pots. But at the same time, in this system, which is not fully defined yet, we have all agreed that we want to have a substantial degree of risk sharing within the system, which goes beyond the risk sharing exclusively of longevity risk or disability risk. So we also want to be able to share some level of investment risk across generations. And I think that's important in the sense that that kind of solidarity in the system is maintained. So we're moving to a kind of a unique hybrid system, somewhere between what was DB and is like an Anglo-Saxon type of CDC system or DC system, but through its mandatory participation and limited degrees of freedom, and I think also in the future auto-enrollment of all people in the gig economy that will have to somehow be part of that system, we will get a high level of solidarity and at the same time clarity and transparency in terms of what your individual benefits will be and how they might be cut under adverse economic circumstances. And I also think, yes. And maybe one other final remark in that regard.
Yes. Yes.
That we have a Pillar 1 and Pillar 2 system. So if things really become bad for the low-income groups, Pillar 1 is always there to provide a buffer against adverse results in Pillar 2. So the government could decide to give extra tax, lower the tax rate on Pillar 1 pensions in a situation where we have a deep economic crisis and Pillar 2 outcomes are more negatively affected for the lower incomes. Obviously, for the higher income groups, that wouldn't be in the cards. But that way you can still maintain stability and outcomes, particularly for those people in society that are most vulnerable, as we want to avoid the poverty trap for all.
Eloy, I admire your optimism in terms of being able to get from where you are to where you want to go. The world is watching. Thank you very much. So the train journey continues reasonably on time. Thank goodness. This next session with Claudia and Ronnie is going to be very interesting. It's going to be challenging in the sense that I think for most of us, It's a discussion around an area that is evolving very quickly. It's quite complex. It's very important. And I think there's still a very big gap between the ideal and current understanding as to where we are, and the gap between where we are and the ideal. So in this next session, which is titled The Rise of Impact Investing, we're going to have a discussion on that topic. The contributors, Claudia Cruz is Managing Director, Global Responsible Investing and Governance at APG, which is the only pension fund in the Netherlands and probably in Europe, larger than PGGM, APG. Sir Ronald Cohen, formal name. Ronnie, I have to say, I looked you up on Wikipedia, and this is how you're described, and I thought it was so lovely, I'm going to read it, okay? I have to find it now. Preeminent international philanthropist, venture capitalist, private equity investor, social innovator, and vanguard of the global impact investing revolution. So that's quite a series of adjectives that describe what you've been up to. We only have 20 minutes for this really important topic, split into roughly 2 10-minute pieces. Claudia, let's start with you, and talk a little bit about the role that you and your 15 colleagues at APG actually work with the rest of the organization to change the whole investment program at APG. What have you been doing?
Yeah, thank you very much for the opportunity to be here today and to be in conversation. So perhaps briefly, we invest on behalf of Dutch pension funds, the largest of which is ABP, which is one of the largest pension funds in the world, and invest around 550 billion in a responsible manner. And that is really what it is about. It is about investing, taking into account risk, return, cost, and ESG at the same time, and making very considered decisions as to what you want to be in your portfolio. So the focus is less. We also have that, of course, an exclusion policy, but the primary focus is really about what is it that you want to invest in and how can you make those choices. So we have a dedicated responsible investment team of 21 people in Amsterdam, Hong Kong, and New York. And then we have very large teams of in-house portfolio managers who are equally enlisted to the effort. And by that, I mean that it is part and parcel of how they invest and how they have to make their investment choices. And one of the aspects that I think is particularly relevant today is our focus on investing into the Sustainable Development Goals. ABP in 2015 set a target of doubling from 29 to 58 billion and has now revised that target to have 20% of its assets under management contributing to the SDG by 2025. That is no small undertaking. It is an ambition that we will realize across our entire portfolio. And there is no dedicated sort of allocation that you say there's a sort of sustainable pocket or so. But really, it applies across all asset classes in the entire portfolio. And that's where we've been focusing on with other asset owners together to build a global standard to facilitate more investments that contribute to the SDGs. I'll stop here for now.
And how just one more thing. And how is that going? Are you happy with how that project is unfolding?
Yes, so far. I mean, we started, the first ambition was formulated in 2015, and we started in 2016 with a definition, a taxonomy, etc. And we launched the platform formally together with PGGM, Australian Super, and British Columbia Investments in July 2020. And the interest has been great because there are, of course, more and more investors who wish to make a positive contribution to the SDGs, and the availability of a systematic approach that truly aligns with the SDGs, and therefore our beneficiaries, was a thing that was lacking in the market. and we can provide the underlying data and the standard, and it is asset owner led and backed, which of course distinguishes this initiative.
Absolutely.
So far, so good.
So far, so good. So Ronnie, this is I think a fantastic lead-in into your contribution in your book, Impact Investing, which argues that we need to, quote, reshape capitalism. Tell us why and how.
Well, first of all, let me thank you, Keith, and thank James, and say just how much I've enjoyed this webinar until now. Torben, Xiong-Guan Lim, and Eloy and Claudia are all names that and people that I have followed with great interest. If I may, I'm going to start off by answering a slightly different question, which is that if we look at pension fund investing, when I started out to create what became Apax Partners in 1972, pension funds were investing basically in stocks and bonds of their national stock exchange and governments. And the arrival of risk measurement changed our portfolios to the portfolios that we have today, multi-asset class portfolios. So risk measurement brought the concept of risk-adjusted returns, the concept of diversification, basically funded the venture capital industry, which funded the tech revolution, and funded globalization through investment in emerging markets, none of which, with the old thinking, would have been possible. I think we're on the threshold of a similar change today. And answering your question, all of us, I think, on this webinar are probably of the view that we cannot continue with our economic system operating in the way it is. It is aggravating social issues and environmental issues too. And the reason is that the capitalist system, which has served us so well for 250 years, is creating such huge negative consequences now that even governments can't cope with them. But if you look at what's happening in the world, and we've heard it mentioned, that Torben mentioned his changes in asset allocation, and Claudia, we've just heard making the same point. Values have changed. Over the last 20 years that I have been involved in thinking and working in impact investment, we have seen a massive change in values. Consumers don't want to purchase the products of companies that are polluting heavily or using child labor, as an example. Talent doesn't want to work for these companies. And it's made us all aware as investors of the implications for the performance of our investment portfolios. And many of us are subject to these changes in views because of our children, but also because of our savers in the case of pension funds, or in the case of asset managers, because of our clients. And this change in values has met with changes in technology which enable us to deliver impact globally at a scale which we couldn't have comprehended even 10 years ago. Artificial intelligence, machine learning, augmented reality are creating massive opportunities for us to improve lives and the planet. And those two powerful trends are converging with a third breakthrough, which is our ability to measure the impact of individual companies. Using technology today, building on the metrics that have been assembled over 3 or 4 decades in the case of environmental data, and a decade or 2 in the case of social data, we are now able to measure the impact that a company creates through its operations, through its products, and through its employment on people and the environment. And we're able to monetize these impacts and reflect them in financial accounts. And I want to just share an insight, Keith, that comes from the work I have been involved with at Harvard Business School, where I chair what's known as the Impact-Weighted Accounts Initiative, which is led by Professor George Serafin. To give you an insight into the future, and the future, I mean the next 3 to 5 years, we have put on the web, available for all of you to access, the environmental impacts in monetary terms created by 1,800 companies. When you look at that data, you begin to see things that are mind-boggling, and they have huge implications for investment, as I'm about to describe. You discover that 250 of these 1,800 companies create more environmental damage in a year than they deliver in profit, in EBITDA. That a third of them creates environmental damage equivalent to 25% or more of their profit. That altogether, they create $3 trillion worth of damage in a single year. And most interestingly for our conversation, that there already exists a correlation between higher pollution and lower stock market valuations in several sectors where impact data has been more plentiful. So if you add to that the employment impact of companies, where we will be publishing the employment impact of about 3,000 companies in just the next 2 or 3 months, and you begin to measure the lack of diversity, the social cost of lack of diversity, by comparing which technology enables us to do in big data, the demographics outside the company's facilities and the demographics inside, and ascribing remuneration levels to the missing people at every echelon of the organization, you discover that a company like Apple, which has a $10 billion annual salary bill, which should all be positive impact, we would think, actually incurs a negative 2.7 billion charge against that 10 billion of positive impact for lack of diversity, unequal advancement, differences in gender pay, and so on. And then if you add to that, and we will be publishing the product impact of several hundred companies in the next 4 or 5 months, the product impact that is created by companies in 11 different sectors, you realize that there is a new frontier for capitalism and for society and for the environment, and that we are basically living through a period of transition similar to the one that I lived through with the digital revolution as a venture capitalist and private equity investor, when we begin to optimize risk return and measurable impact. And that is reshaping capitalism. It's moving the goalposts for businesses. Businesses have to deliver both profit and impact. And the evidence is that if you optimize risk return impact, partly because of the changing values, but also because when you analyze things from an impact perspective, you discover huge underserved markets with innovative new models that can address them at acceptable price level. Because of that, we're going through an impact revolution.
Okay. So I have a logical question here now for Claudia. Are you interested in impact measurement in your work?
Yeah, I mean, that's why we, our investment or contribution to the SDG you could argue is the equivalent of that, because we are looking to make a positive contribution to the core business of the companies that we invest in, so to solutions to sustainable development challenges, rather than looking at the conduct of companies. Have they improved the energy efficiency of an oil refinery? That is not what we're looking for, but products and services. However, we are very careful or conservative in terms of stating what we are able to measure so far. If you have a large global portfolio like we do, it is of course much easier for certain type of dedicated impact investments to really look at the outcomes on the ground. But also through our platform, we want to move towards finding truer real outcome metrics. And you may have noticed that also the PRI is applying the language of outcomes, which I think is a very good terminology to look at, in terms of how can you be part of the solution. And for us as a pension fund investor, it is of course you have the large global portfolio, but you also have it directly in front of your doorstep. We serve 4.5 million Dutch people of a population of about 16 or 17 million. So it's quite substantial. And there is, for example, ABP has a portfolio which is dedicated to financing the energy transition locally. That makes a direct difference to those whose pension money they invest or we invest on their behalf. And I think it's sort of this local global nexus that will become increasingly important. The connection with your beneficiaries to understand what their desires and wishes are in order to invest properly on their behalf. And one, also for me, what is very important, that our sustainable development investments, we don't make any concessions when it comes to risk return. So we are of the belief that you can find those investments and meet your risk return targets. We also considered our duty to actively communicate to the market that we would like such investments, and that we would like them to be structured in a manner that an institutional investor like us, and on top of that, a pension fund investor, can actually allocate money to them or capital to them. And we do find that there's quite some interest in understanding our expectations around the SDI taxonomy, or it could be green bonds, etc. So it's also about a dialogue with your stakeholders and other market participants.
I think that's the one side, is the dialogue. The other side that I'm just sort of conscious of it is that you're almost developing a whole new dimension of investing, a whole thought process that really hasn't been part of the past. That's going to require new thinking, maybe new academic courses to get people more familiar with this whole area. The whole data side of turning data into information that actually means something. This is a really big thing that you're talking about, is my sense. That's really, I think, underappreciated, not well enough understood. And so thank you for kind of opening, I think, the eyes of the people that are listening, and ears of the people that are part of this, because I really do believe that you're still, I think, at the beginning, but it's got to move rapidly, of this whole new dimension of investing that is just really starting. And clearly, both of you are in the vanguard of making this happen. So thank you very much.
Pleasure.
Thank you.
So now we go, a final word, Ronnie.
I was going to say this is going to be driven by performance, which may sound strange to people who haven't been familiar with this thinking. Look at the valuation of Tesla today, $800 billion multiplied by 7 times in a single year. Look at clean energy ETFs in 2020, doubled or trebled. Look at the outperformance by ESG funds. There's huge momentum in the market now for companies that can optimize risk, return, and impact. And with $40 trillion flowing now, which is basing decision-making on impact data, or including impact data in its decision-making, we're talking of the equivalent of half of all professionally managed assets in the world. And actually, although pension funds started this, pension funds like PGGM and the others here, PD and APG and others, it's the asset managers that have been driving it, not the asset owners so far.
Right. Just my sort of one caveat in all this is, no, there is still a lot of short-termism out there, and this has now become a hot topic. And my fear is that some of it is being driven by short-term investors that see momentum and are just riding momentum without really having a clear understanding of what this whole area is about. So I think, that's the caveat that we have to keep in mind, that we're talking about, long-term sustainable cash flows and not short-term flips.
But it's interesting that at the Procter & Gamble shareholder meeting 6 weeks ago, 2/3 of shareholders voted against management because of the deforestation that PGGM is causing through its use of palm oil, Keith. So this isn't just about momentum. It is about a change of values which is driving momentum. And when the momentum goes out of the market to the extent that it does, those changes in values still exist, and there'll be new companies like Tesla's and others that attempt to disrupt sectors. This is going to be like the digital revolution again, as I say in my book, Impact.
And that's why I think, because of that long-term horizon, that's why the role of asset owners will be so key. Asset managers manage money on their behalf. And so that's what I think, that's why they have a key role to play. And I prefer not to call it a new way of investing, but I think it's a natural evolution and an inevitable evolution of investing. You have to build on what is there, and that's where we go.
Narrative matters. I think storytelling is a very important part of the dynamic of this whole thing. We've run a little bit over time, but it was well worth it, I think, for everybody. So thank you very much. And now, Rebecca, the moderator for the discussion session at the end.
Thanks. Thanks, Keith. It's
been a
fascinating time to hear from all of you. And I will attempt to share some of the questions from the audience and maybe just start out as everyone's gathering here to offer a couple observations. I thought it was particularly interesting the way there were a few themes that came up over and over again. In particular, lots of discussion around confidence and trust in the system. How do you maintain that? How do you build that at the beginning if you are trying to innovate? I think Claude had said there was no way that he could have done such innovation without that trust internally, and then again to different stakeholders. I think some of the other elements that seemed like they built trust and confidence were around a holistic approach, like we heard about in Singapore in particular, customization, Torben mentioned, and Eloy mentioned transparency in particular, and increasing transparency there. So that seemed to be a very big theme that crosses lots of different markets and others can learn from. Of course, there was a lot of helpful conversation around the current investment environment and how to deal with low interest rates. I think we didn't necessarily get into too much about what happens now, during post-COVID. There were a few mentions about how maybe the perspectives have changed with more connectivity and so forth, but I think that continues to be an area of interest. And then Keith led us off talking about how this was really an effort around integrated thinking. And so at CFA Institute, we've talked a lot about the investment ecosystem, and it was great to hear the ways that everyone made the connections about the beneficiaries or members, the asset managers in some cases that you're working with, and also the collaboration across these types of, across asset owners and how we can work together on some challenging areas. So I think one other key impact to mention is just around innovation and culture. James writes in his book that pensions are maybe considered important but not urgent. And Xiangguan mentioned that change happens when there's crisis or people can imagine a crisis. So I think we are coming to a point where there is a lot more urgency around what does the future look like. And even though the premise here, again, is that these were smaller markets that have succeeded, we still look at the number of people that are impacted by the work you do, and millions and millions of people. And so I think that that is especially encouraging to those of us across the investment industry, thinking about what is our purpose. And these changes, these approaches you have taken really do have wide-ranging, long impact. So thank you for that, and I'll get to a couple of the questions then. So one of them is about getting your thoughts on why some attempts to bring in private pension systems in emerging markets haven't worked out well. I wondered maybe if Eloy, you could try to, if you could start us off, and then maybe Xiangguan, we could go to you for a comment.
So maybe one of the explanations of success of bringing pension systems on board is the auto-enrollment or mandatory participation. So I think some countries have been successful that have implemented that aspect, and others that have left that more open have found it much more difficult to create the level of scale which is necessary to build a good pension industry. And the other thing is regulation. You need supportive regulatory and I think also supervisory arrangements to make sure that the organizations that get started have the right risk management systems in place, the right governance, that you build trust from the start. So some level of, I do believe that supervision is part of that.
No, I agree this point about you have to make it mandatory. But the thought that comes to me when I talk about private pension systems, if we bring in the private sector to handle the let's say to handle the investment part of it, and the government comes in or body linked to the government actually fronts it. I think a lot of time people just don't have enough trust in the private sector or private pension operator, and some of the things if they read about what's happening around the world and so forth, it must make them feel rather nervous about it. In the end, maybe it's more the government that's going to be around for the longer term. For the private operator, they come in. If they fail to produce the results, people get impatient with them. After 5 years, they are out. But what happens to them? Who bears the penalty of all that? So at the end of the day, the penalty will always have to be borne by the government. So it seems to me that bringing a new pension system, it probably will work much easier if the government were to front it. The government not try to contract out its responsibility, but at the same time to say governments are not very good in the investment game, and they ought to bring the private sector to undertake that task.
Thank you both. And I think one of the things I noticed too, as we went through the conversations and certainly looking at your backgrounds, is that all of you have had pretty long tenures at the organizations you've been at. And so again, it points to the fact for stability, relationship building, and really thinking through the long term. So I think that is a great benefit and commonality there. Another area that many of you spoke about was governance. And again, closely related to trust and building confidence. And I wondered if Claude and maybe Claudia, if we've got her as well, might talk about governance and incentives and how you think about that. Claude, I know you've been very involved with the Canadian Coalition for Good Governance, and so maybe you can talk a little bit too about the motivation for that and how it might help pension funds.
Well, I can tell you a story about the Canadian Coalition for Good Governance. When it was created by Stephen Jarodowski and myself, we invited a group of pension funds. And at the end of the meeting, everybody agreed with what we wanted to do, to have a voice and to be able to talk to corporations and to make some changes. But when we announced that we wanted to, I had drafted a press release, and I'd say 3/4 of the people went under the table when we said we have to talk to, tell the public that we're doing that. And you talk about transparency. Public funds, if they want to make changes, have to be a little bit more present. I've always treated journalists as my friends. When we invested in the, swap and derivative, if a journalist called me and said, I understand you're doing this terrible thing, I said, well, come to the office. We'll take whatever time it takes to explain to you what we're doing. And at the end, they would normally go away, with Bob Bertram and myself. They would go away and say, oh, that's it. Yeah. So pension funds have to be more transparent themselves. And if you want to have an impact, you got to talk and you got to tell your story. Governments, one of the problems with governments, most of them, the long term is the next election. A pension fund has to think about generations, not the next election.
Well said. So Claudia, I know you've done some work thinking about governance and incentives in particular, and I wondered if you could talk a little bit more about how you see that playing a role too in, in the impact trend and so forth.
Yeah, certainly. I think there's the whole spectrum of corporate governance. I think is a key conduit in this regard, because in the end, it is about who is on the board of a company or of any entity. Therefore, who sets the tone, who sets the strategy, and also who incentivizes people to deliver on board. And we increasingly see that also sort of longer term factors, including but not limited to sustainability, are incorporated into incentive structures. And our focus is always on that it has to make sense in how they're being incorporated. For example, we don't like relative measures like a position in an index or something. It has to be truly linked to the company's business, its performance, and its strategy in order to set the right kind of incentive.
But, for me also, having a good board makes a huge difference. Why we were able to do a number of the things that look crazy at teachers is you need a board, you need generalists and you need specialists. And the board has to be patient on occasion with what looks like new initiative. We bought Cadillac Fairview. That was the largest company, real estate company in Canada. It's still owned by Ontario teachers. But initially, that looked like a huge risk. People were, wow, what are you doing? And so we convinced them that this made sense. Here's how we're going to manage it. But you need a board to understand that. And a lot of times, boards shy away from taking long-term, making long-term investments. And sometimes you have to accept lower returns for a while. Eventually, it will pay. But boards have to be convinced of that. And too many corporations, everybody's looking at the short term. Most incentives are based on the short term. In fact, in Canada, the law doesn't permit you to delay incentive more than 4 years. To me, it should be much longer than that. People have to think really long term, and you need board to understand. I think Ronnie had, I think if people want to look at the impact, they have to think in terms of 20 years, not 2 months.
Yeah, and I think it's not only incentives at corporates, right? It's also incentives within investment management institutions. Are they sufficiently aligned with 3-5 year horizons? And how are mandates set to enable such a long-term horizon?
One of the disease right now is giving guidance. You look at many corporations, they give guidance, and when there's a problem with the corporations, a lot of times you can look at the guidance. Everybody, I read this summer the book on Lights Out that is on GE. And essentially, if you give too much guidance, eventually there's cheating, people take shortcuts, and everybody loses.
Well, thank
Rebecca,
you.
I thought, if you allow me, just make and just tell a little story. I'd earlier explained my presentation about GIC being the sovereign wealth fund, but GIC is 100% government-owned company. The Singapore government owns 100% of the company. Well, when it first started, there was this discussion or argument between the finance minister and the prime minister as to who should be chairing the company. And the prime minister said that GIC is about investing, so you, the finance minister, you should chair. And the finance minister said, no, you, the prime minister, you have to chair, because the investing is just a technical part of it. The real accountability is political. So I'm saying that as we talk about governance, we need to be clear about the responsibility, particularly when you talk about longer term investing, when you talk about pension funds. The responsibility requires the board, and most particularly requires the chairman who understands this big picture of what the responsibility is about, rather than see his role as fundamentally about looking at the technicalities of the investing.
There's actually now some good research on board composition and performance. And one of the clear drivers of underperformance is the proportion of board members who are politicians.
Well, that's a good point, Keith. Let me pose a question here now to Torben. Again, comes from our audience. So, but it's a broader question. So the question is, how do panelists think about the democratization of pension funds? So, in other words, allowing contributors to decide what to and what not to invest in. Of course, this connects into the sustainability and impact areas as well. But I think you spoke quite interestingly about the innovations that you're taking on in terms of customization. And I think people would like to know more about that.
Well, I think the move in most pension funds is towards customization of both product, but also of investment decisions. In our pension fund, we have a default investment program, but every member can actually opt out of this default program and make her or his own choices. We call it a unit link system, where you can choose different risk profiles, but still managed by our investment team. You can have to decide to have a large allocation in your own savings into, let's say, sustainable fund structures with even a larger weight on sustainability. And you can also actually decide to allocate your savings into, let's say, external investment funds managed by a number of asset managers. The vast majority of our members actually go for the default option. So less than 5% opt out, but also the other 95% actually are expressing satisfaction with the fact that this option is there. Because our members are blue collar workers with quite limited financial competences, which they are very well aware of. And I had a discussion with some of the shop stewards in the building industry. They say, well, we are very good bricklayers, and we hope that you are very good investors. So I think that for some time the individual dimension will still be limited, but I think the option should be there. I think, but democratization is not only it's not the same as individualization, because we have a board with representatives from both unions and employers' organizations as the social partners, which play a strong role in Denmark, especially on the labor market. They are elected by their members, and they have to stand up and ask at the, let's say, union congress, at the meetings for shop stewards and so on, what's going on in the pension fund. So there's a strong focus in our board to make sure that we are managing the fund in a cost-effective way, that we can achieve competitive rates of return, and we have a high ethics in our investment policy. So I think that you should put more attention to governance and to educate the board members and make the board members, let's say, accountable. Plus, have a high degree of transparency. I mean, on our website, you can see all our investments, every single share in our portfolio of shares, both listed and non-listed. You can access, and that's a link, so you can explore what's going on in the companies in the portfolio. You can see all our real estate, all our infrastructure. So it's 100% transparent, which actually I would recommend other colleagues in the industry, because transparency actually makes it clear that we are not hiding anything, and we will stand up and explain and defend our dispositions. We have, as I mentioned, we have allocated a really large part of the portfolio into as a direct investment into renewable energy infrastructure. Actually, we are now the owner of 3,600 gigawatt of clean green power production capacity through solar and wind parks and things like that. This is actually equivalent to a little more than the yearly power consumption of our 750,000 members. So my storyline is that we're not only providing you with good pension, but also with clean power. So when you turn on the light in your house, it's green power from your own wind turbine lighting up the place. This is it's a way to make sustainable investment understandable for ordinary members. I think we have to find ways to showcase what is actually the way we are trying to make an impact investing.
Yeah.
Just make the last one. I think that what was said in the previous session was very important. I think if you look 10 years back and you said, I want to be a responsible investor, it was always only about having exclusion lists, blacklisting bad companies. Then we realized that by setting off those companies, nothing happened. So the stock only bought by not so responsible investors. So then we moved to what we call concept 2.0, saying that being a responsible investor is to be an active owner. And we have engaged in dialogue with companies. I think that we are now seeing a transition into what you call version 3.0, saying that you should also be accountable for the impact of your investments. And I fully are in line with Claudia that that we should try to use the UN SDGs as the benchmark for which we will try to measure our impact. Instead of measuring listing the number of engagements with companies, we should try to develop metrics where we can document the impact on a number of the SDGs through our investment portfolios.
Thank you. Yeah, I think there's a lot more coming, right? And it's been great to hear from everyone here. Really, thank you for being generous with your time today. And I think one of the themes too was about being cost effective, right? So hopefully this has been a good return on time for everyone here. We've packed a lot in. Thanks, Keith, for driving the train and keeping it all on the tracks. And thank you, James, for inviting me as well to participate. So back to you.
James, you're on mute.
Yeah. So thank you very much. I mean, fascinating discussion, and what a treasure of wisdom, experience, exchanges. Hopefully also gives you a sense kind of what the S8 community is about. it's about excellence. So we have fantastic people who have unprecedented experience. There aren't any posers. We don't hear any political speeches or posturing. It's very down to earth, very modest people. And we'll continue like that. The next webinar we will have in a few weeks is about Israel's phenomenal vaccination program, the success that they've had, which of course is incredibly important to figure out ways to encourage people to take up vaccination. I just wanted to make a couple observations, a bit like Rebecca, which I thought she did a fantastic job and summarized very well. But I was just thinking as everyone was talking that it's just been an incredible experiment, these pension funds. Up until 1900, we've had human beings, Homo sapiens, for 2 million years, and up until 1900 we lived to be 40, and there was no such thing as a need for a pension. There was no need for surplus, and then suddenly we're now living to be 80 years old, and it looks like it's projected to go up. So all of this has happened in the course of the last 3 or 4 generations. So it's a daunting experiment to get this right. And I just thought it was sort of interesting to put that into perspective, how we've gone from a non-surplus, no need for pension environment to one where quite the opposite, where as Ronald Cohen mentioned, we have 40 trillion of assets circulating in these pension funds. So there's a huge vessel of power and responsibility. And of course, people like Claudia and Eloy and Xiangguan and Torben, they're incredibly important and have a huge amount of responsibility as custodians for those funds and how they would be deployed. But what's interesting is that these pension funds are also emerging as the decisive owners, in the sense of owning responsibility, in terms of also having long-term sights in terms of what they can do. Torben mentioned investing in these solar farms. These are not things that you can't do this day trading. These are very long-term commitments. So I think in many ways they will be increasingly important in terms of having influence in passing on the industrial treasures of the nations they represent. So I think that's really, really important going forward. I think just looking at why this could be relevant to a lot of other people who are not coming from these countries. Well, given the fact that they're outstanding and they've performed so well, the delta between an outstanding fund and a mediocre fund represents a huge amount of opportunity to improve. So, hopefully through initiatives like this, we can really encourage lesser performing funds to learn and to adapt some of the principles of these better performing funds. And I think, this point that Ronald Cohen mentions, that this is just a transition, this is a journey, just as pension funds have sort of have taken us into the world of venture capital and enabled the funding of these Teslas and Stripes of this world and Adgens, et cetera, and then emerging markets. Now we're entering to this phase where people are becoming more concerned about ESG and more about impact. What the session that Claudia was very lucid in pointing out to. This is the next wave, and the futures are already arrived. So the people you've met today are at the cutting edge of those developments. I was also interested to see how people really learn from each other. Claude mentioned, I think Eloy pointed out that the Dutch have learned from the Canadians how they were able to goose up returns and to really take ownership of the asset management function and to hire these fantastically talented people as opposed to just paying fees to Goldman Sachs and to BlackRocks of this world. And then Claude mentioned that they learned from the Dutch this element of frugality, looking after costs, and also this point about the trade-off between choices and complexity. And then the people, this point that Torben mentioned, that we have to look to longevity as a safety valve in order to try to make the books balance. And then just as a final observation, this point, what's really important doesn't seem to be measured yet, but as Sir Ronald pointed out, that this is now developing a new vernacular, a new accounting standard, to actually measure these things, because what gets measured gets done. And that's all incredibly exciting. And I suspect that you're going to be hearing a lot more of that sort of thing coming from the likes of Ontario and APB and PGGM and the Danes, etc. So all very exciting stuff. And I'm really happy that we could help, sort of create a showcase for this type of thing. So I really appreciate everyone participating as speakers and everyone also listening visually as an audience and submitting, challenging questions, etc. And thanks, Jacob, for all the work and for organizing it. And Keith, a terrific job keeping the trains on time.